Okay, class, in this lesson, we are going to learn to compute both the average daily balance and the finance charge. And then we're also going to identify the various entries that are pertinent in a credit card statement. So let's go ahead and get started with some terms that you should become familiar with first. Okay, so account number I think that's pretty straightforward. These are credit card account number that is unique to your account. The credit line is the maximum amount that you can owe at any particular time, and then the available credit is what's available after charges are made. So credit line minus whatever you've charged, then available credit is the difference between the two. The billing date is the date of the statement bill that was written. Okay, and so we will understand this, the importance of the billing date in just a minute as we go through some of these examples. The payment due date obviously is the date that the payment is due. Since you will be receiving monthly statements from the credit cards, assuming that you have charges or you have unpaid balances, then you will want to know what the payment due dates are. Transactions will list where purchases were made and the date, as well as any credits. So if you've got a refund or you've made payments, you will see that in the transaction section. Debits and credits. So a debit is the amount that you charge to your account, and then a credit is what's credited back to your account. So a credit is essentially a payment, or if you've returned something, that amount will get credited to your account as well. Okay. Previous balance, this is any money that you owed before the current billing period, and then payments or credits are total amount received by the creditor. New purchases, these are the sum of purchases or debits on the current bill, and then late charge is the penalty for late payments from a previous month. Finance charge, this is the cost of using the credit card for the current billing period if not paid in full. New balance, this is the amount you currently owe. Okay, and these are all terms, information that you're going to see in a credit card statement, and we will cover that in just a minute. Minimum payment, this is the amount or the lowest amount that you must pay to the credit card company for a given month, so that the credit card company will accept it as for the current billing period. And then the average daily balance, this is the average amount owed per day during the billing cycle, and I will show you how we will calculate that. Number of days in the billing cycle, this is the amount of time and in days covered by the current bill. And then the monthly periodic rate is the APR divided by 12. Okay, so hopefully that made sense to you. Let's go ahead and get started with the first example. And we're going to start with computing average daily balance. Okay, so in this example, we are told that Rebecca did not pay last month's credit card bill in full. Okay, so she has a balance. Below is a list of Rebecca's daily balances for her last billing cycle. Okay, so for 7 days, she owed $456.11. So we would go ahead and write the following: 7 times $456.11, and that's going to equal $3,192.77. And then for 3 days, she owed $1,177.60. So we're going to write 3 times $1,177.60, and that's going to work out to $3,532.80. And then for 6 days, she owed $990.08. So we're going to write 6 times $990.08, and that works out to $5,940.48. And then for 9 days, she owed $2,115.15. We're going to go ahead and multiply that out. And when we do, we get $19,036.35. And then lastly, for 5 days, she owed $2,300 $309.13, and that works out to $11,545.65. Okay, so then what we're going to do is add all of these up, and when we do, we get $43,248.05. So then to find Rebecca's average daily balance, we're going to take this total and divide it by the sum of these days. Okay, so 7 plus 3 plus 6 plus 9 plus 5 gives us 30 days. So if we divide this whole thing by 30 days, then our average daily balance works out to $1,441.60. Okay, so let's go ahead and move on to example 2. And for this example, we're referring to the previous example where Rebecca pays a finance charge on her average daily balance of $1,441.60. We're told that her APR is 18%, and so what is her finance charge for this billing cycle? Okay, so the way to calculate this is take the APR. Remember, this is an annual percentage rate, so we're going to need to divide that by 12 because there are 12 months in a year. And when we do, that works out to 1.5%. Okay, so we're going to take that 1.5% and we're going to multiply that by our average daily balance of $1,441.60. Now remember, when you multiply by 1.5%, you have to convert it into a decimal. So this works out to 0.015. And when you do this, it works out to $21.62. Okay, let's go ahead and move on to our third and last example, which will be very similar to what we did in example 1, but example 1 was sort of a simplified scenario. So I'm going to go through what you would really go through when we're looking for the annual or the average daily balance. Okay, so for number 3, we're going to calculate the average daily balance from a given credit card statement. Okay, so this is a snapshot of what a particular credit card statement could look like. Every issuer lays this out a little bit differently, but let's take a look at some of the key components. Okay, so account number is listed here. We have the billing date. We have the payment due date. Okay, here is the list of the transactions, the date in which those transactions took place, and then whether it was a debit or a credit. Okay, so a debit will be a positive number. Okay, a credit would be a negative number. Okay, now here's the summary section. The summary will give you the previous balance, any payments and credits that took place, new purchase, total new purchase that took place, any late charges if they are assessed. We're going to calculate the average daily balance here, and we will also calculate the finance charge and also the new balance. This is the minimum payment amount. So if you can't afford to pay the full balance off, then this is the minimum payment that the issuer will accept. This also tells you the number of days in a billing cycle, the APR, and then the monthly periodic rate. Okay, so the best way to do this is to use a spreadsheet, although you don't have to use a spreadsheet. You can use a piece of paper and kind of chart this out. But let me show you what I mean by this. What you're going to do, oops, my apologies. What you're going to do is make a grid that is 7 columns and 5 rows. Okay, 7 columns and 5 rows. And you're going to blank out the last 4 cells. Okay. And then you're going to label the very last box number 26. Now, where did I get number 26 from? So let's go back to our statement, okay? You notice that our billing date is June 26th, okay? So we're going to put the last day, number 26, in this last box here, okay? And you're going to work your way backwards. So 26, 25, 24, 23, 22, 21, all the way up until 27. Okay, notice that we go back to 1 in the very top row, and then we go to 31 because we're assuming that there are 31 days in a particular billing cycle. Actually, we're not making that assumption because we're told over here that the number of days in the billing cycle is 31. Okay, so we're going to go to 31 days. Okay, now, once you set this up, then what we're going to do is start with the previous balance, which is $800. Okay, so we have an $800 balance, and so we're going to put that right in here, $800. Okay, and so now we've got $800 running across the entire month. The second thing we want to do is add certain transactions. Okay, so we have a transaction that took place on May 31st, and it was in the amount of $251. Okay, so we're going to notate that on the 31st, that $251 took place. Okay, so I have my spreadsheet automatically calculating the sum. Okay, so we were running an $800 balance until the 31st. There was a charge of $251, so that amount gets added to the $800, and now the current balance is $1,051. Okay, then we're going to take a look at the next transaction, which took place on June 12th in the amount of $72.50. So on the 12th of June, we're going to put down $72.50. Okay, and notice that my spreadsheet automatically updates the total to now $1,123.50. Okay, and then the next transaction took place on the 18th of June, and there was a payment that that was made in the amount of $200. So on the 18th of June, we're going to go ahead and put in $200. Okay, notice that the balance now drops down to $923.50 because a payment was made. So now our daily balance is dropping to $923.50. And then the last transaction, which took place on the 20th of June, was in the amount of $18.50. So we're going to go ahead and put that amount in on the 20th of June, and that was $18.50. Okay, now what we're going to do is notate the following. Okay, starting on the 27th of the month, for a total of 4 days, we ran a balance of $800. Okay, so for 4 days, we ran a balance for $800. Okay, so that gives us a total of $3,200. Okay, 4 times 800 is 3,200. All right, so then starting on the 31st and going all the way to the 11th, okay, so that's, we would count the number of days, so 31st would be 1 day, the first would be second day, the second would be the third day, the third would be the fourth day, and so on. And so when we get to the 11th, that would be the 12th day. Okay, so for a total of 12 days, we ran a balance of $1,051. So 12 times 1,051 gives us $12,612 in total. Okay, now starting on the 12th of the month, and for 1, 2, 3, 4, 5, 6 days, we ran a daily balance of $1,123.50. Oops, $1,123.50, not 11,000. And 6 times 1123.50 gives us 67.41. Okay, and then for 2 days, starting on the 18th and going through the 19th, our balance dropped to $923.50, giving us a total of $1,847. And then lastly, starting on the 20th, going all the way to the end of the month, that's 1, 2, 3, 4, 5, 6, 7, for a total of 7 days. We ran a balance of $942. Okay, daily balance of $942. So now this exercise should become familiar to you because this is now very similar to what we did in example 1, but I wanted to show you kind of the minutia that really takes place to get all of this information. Okay, so we've got all of these multiplied out, and what we do is we add them all up and we get $30,994. The number of days should add up to 31, which it does, and so our average daily balance is going to be $30,994 divided by 31, which works out to $999.81. Okay? So our average daily balance is average daily balance works out to $999.81. Okay, so that information would go in this part of the statement right here, average daily balance. Now the credit card company will automatically provide this information. Okay, we just left the bank for the purposes of this exercise, but when they give you this figure and it's $999.81, you now know how they arrive at this number. Okay, now the finance charge is going to be the APR divided by 12, and they've already given that to you, 1.5%. And so our finance charge is going to work out to $999.81, and we're going to multiply that by 0.015. Again, we have to convert the percentage of 1.5% into decimal form, and when we multiply that out, we get $15. Okay, so that is a finance charge. Okay, hopefully that made sense. If any of this was confusing or if you need further clarity, please go back to the beginning of the recording and listen to this again. Thank you.